Although we've done it in our introductory videos, I'm going to briefly describe what is a DSCR loan. DSCR stands for Debt Service Coverage Ratio, and essentially this is an asset-based loan that is based on the value of the property and the cash flow of the property. We'll, of course, need to make sure that the purchase price or that the purchase price is at or less than the appraisal value. And as long as that happens, and as long as the actual or expected cash flows of the long-term rental covers the debt service, the fully loaded debt service, meaning including escrow for taxes and insurance, as long as it covers that by a 10% cushion, then the loan will qualify. It has nothing to do with the number of other properties you have, your personal financial statements, your experience, your other income. As long as that cash flow will pay for the debt service, and as long as you have good credit, which I've talked about in other places, but is generally 680 or above, then you'll qualify for a DSCR loan. Whether it is a 70 or 80% loan really depends on your credit, but if it's 720 or 700 or above, rule of thumb, then we'll generally be looking at an 80% loan to value. If it's a refinancing, then it will probably be 75%. But that's the short story of what a DSCR loan is. We provide these types of loans for 1 to 4 units, homes, single-family homes, duplexes, triplexes, quadplexes, and in certain circumstances, small apartment complexes. These are 30-year loans, so instead of them maturing in 5 years like bank loans do or other places, these are 30-year fixed-rate loans, and that 30-year fixed rate will provide for a lower payment compared to a 5-year loan that typically amortizes over 20 or 25 years. So the payment will be lower, all other things being equal. So that's a quick summary of what a DSCR loan is.